Introduction: gap lending and gap funding are essential financing methods for real estate investors who need to cover the shortfall between their primary financing and the total capital required for a real estate project. These tools are particularly useful in scenarios where investors have secured a primary loan but still require additional capital to complete a deal. What is gap lending and gap funding? Gap lending. This is a short-term loan used to cover the difference between the primary loan amount, like a traditional mortgage or hard money loan, and the total funds needed to complete a real estate deal. Gap lenders provide funds when the main lender doesn't cover the full purchase price, rehab costs, or other expenses. Gap funding. This refers to the capital provided by investors or specialized lenders to fill the gap in a real estate project's financing. This can include the difference in the cost of acquisition, repairs, and other associated costs not covered by the primary lender. Means and methods of gap lending funding. 1. Traditional lenders. Some private or institutional lenders offer gap loans to investors, typically based on the property's value and equity. 1. The loan terms may vary depending on the borrower's financial history and the risk of the project. 2. Private money lenders. These are individuals or private groups who offer funding for real estate deals, often focusing on high returns. 2. They may be more flexible in their terms than traditional lenders, but will typically charge higher interest rates or require a larger share of the equity. 3. Hard money lenders. Often used in conjunction with gap lending, hard money lenders provide short-term loans based on the value of the property rather than the borrower's creditworthiness. 3. They can be an excellent option for investors who need quick access to capital. 4. Equity partners. An investor can bring on an equity partner who will contribute funds for the gap. 4. In return, the equity partner will typically receive a portion of the profits or returns once the deal is completed and sold. 5. Crowdfunding platforms. Real estate crowdfunding platforms are increasingly offering gap funding options. 5. These platforms allow multiple investors to pool resources together to fund the gap in a project. Do's of gap lending funding. 1. Conduct proper due diligence. Ensure that all parties involved, including the borrower, project, and the primary lender, have been thoroughly vetted. 1. Review the borrower's track record and the property's potential value upon completion. 2. Clarify loan terms. Be clear about the interest rates, repayment schedule, and collateral requirements. 2. This avoids misunderstandings and establishes expectations between the lender and borrower. 3. Have a solid exit strategy. A clear exit strategy is essential. 3. The borrower should have a solid plan for either refinancing the gap loan or selling the property once the project is completed. 4. Use a loan agreement. Always document the terms of the loan with a formal agreement. 4. This will protect both parties and provide a clear understanding of the responsibilities and obligations of each party. 5. Hire legal counsel. It is highly recommended to have legal counsel draft or review any loan or funding agreements. 5. This ensures compliance with local and state laws and protects against potential legal issues. 6. Require a personal guarantee. In some cases, lenders may require the borrower to personally guarantee the loan in case of default. 6. This ensures that the lender can claim personal assets to recover the funds if necessary. Don'ts of gap lending funding. 1. Avoid unclear terms. Do not enter into agreements without clearly defining the terms of the loan or funding. 1. Ambiguity can lead to disputes and financial losses. 2. Do not skip appraisal and inspections. Never fund a project without a proper appraisal or inspection. 2. This ensures the property has adequate value to back the loan or funding. 3. Avoid over-leveraging. Be cautious about offering too much gap funding. 3. Over-leveraging can make the investment too risky for both the lender and borrower. 4. Do not neglect communication. Frequent communication between the lender and borrower is critical. 4. Keep track of the progress of the project to ensure everything is proceeding according to plan. 5. Avoid using non-liquid assets as collateral. Unless you are highly confident in the project's success, avoid accepting non-liquid assets like personal property as collateral. 5. It's essential to have assets that can be easily liquidated in the event of default. Necessary paperwork to complete and close the deal. 1. Loan agreement contract. A formal contract outlining the terms, interest rates, repayment schedule, and other critical components of the loan. 1. This document serves as the official record of the gap loan and should be signed by all parties involved. 2. Promissory note. A promissory note is a written promise by the borrower to repay the loan. 2. It includes the loan amount, terms, and interest rate. 2. This note is important for legal purposes and ensures the lender's rights are protected. 3. Deed of trust or mortgage, a legal document that secures the loan by pledging the property as collateral. 3. This document is recorded with the county and ensures the lender has a claim on the property in case of default. 4. Title insurance. Title insurance ensures that the property is free of legal claims and encumbrances. 4. This protects both the borrower and the lender from future legal disputes over ownership. 5. Disbursement agreement. This document outlines how the GAP loan funds will be dispersed to the borrower. 5. It ensures the funds are used for the specific purpose outlined in the loan agreement. 6. Exit strategy. Agreement. This document outlines how the borrower plans to repay the GAP loan, whether through refinancing, selling the property, or other means. 6. It should clearly define timelines and contingencies. 7. Personal guarantee. If required, a personal guarantee is a document signed by the borrower personally guaranteeing repayment of the loan. 7. This is especially important for GAP lenders who may not have the same level of security as traditional lenders. 8. Insurance coverage. The lender may require proof of insurance coverage on the property, ensuring that it is protected in case of damage, fire, or other risks. 9. Lien waiver, if applicable. If the project involves contractors or subcontractors, a lien waiver ensures that no mechanics liens will be placed on the property for unpaid work. Conclusion: GAP lending and GAP funding play a vital role in enabling real estate investors to secure the necessary financing for their deals. By understanding the methods, ensuring all documentation is in place, and adhering to best practices, lenders and borrowers can mitigate risks and increase the likelihood of a successful investment. Whether you're a GAP lender or a borrower, being clear about terms and maintaining open communication are crucial to making these transactions smooth and successful.